I was actually just checking out a property we just bought in London, Ontario. It's a quick flip, so that was an eventful day today, getting 2 deals closed. It's always stressful for some reason in real estate. Whenever there's a closing, it's always stress between the lenders and the lawyers and whatever the wholesaler, whoever's involved. There's always a level of stress. Each deal's different. Some deals have a little stress on one end, some have a lot of stress. But I've just noticed it's a very common theme. Today we're going to talk about cottage life. The last week I've been living out at the cottage. If you've been following on Instagram, you know that I've been hanging out at the cottage, just enjoying. Lake Huron's a beautiful lake, and we have a nice spot there on the water, and I get to stay there. My house closes. You can see, you can't really see, but I'm surrounded by boxes right now. And if you guys have any questions, drop them down below. I just kind of threw this up as a clickbait because it's what's up right now. To be honest, it's not a very clickbaity title, but yeah, we're in the middle of like getting ready to move, and I'm gonna be leaving this house in 2 weeks. So I'm preparing for that, and I'm gonna be homeless, living at the cottage until September 1st when my new house closes. And so that's a exciting life development to not have a home location. It's gonna be different for us. One thing I love about being out at the cottage is the cell phone service is terrible there, and you might think that's a terrible thing, but I love it. I go down to the beach and I have almost like 1 bar to no bars, and I get no interruptions. I enjoy time with my family. I'm just sitting there on the beach. If I want to sit back towards the hill, I get a bit of signal, and I can do a little bit of options trading. I was doing some options trading this past week, on Monday and Tuesday on the beach, and that was cool. I made significant amounts of money. It's been an insanely good ride in the market right now. I'm at all-time highs in my options trading portfolio. If you remember a couple weeks back, I made a video on losing 500,000. I've made all that back and more. So it's been extremely great to come back to new all-time highs, and it's a great feeling. I'm de-levering now. I don't know what's going to happen. I feel like the market could keep roaring. We could have catalysts for recovery from COVID that continue to drive the market to all new highs. I don't know though. I'm going to de-lever. I'm going to take some profits off the table and continue to dabble, but just on the down days, puts way out of the money, like 30% away from current stock price. So if there's a crash, I may take the shares, but I want to own them anyway, and that kind of thing, right? So I've just been, honestly having a little bit of fun with things and relaxing. And so whatever you guys have for questions today, let me know. We could do a short stream today too. I'm cool with that. It's a Canadian dream. For those people who are kind of new to the whole cottage life thing, it's a Canadian dream. Like there's an American dream and a Canadian dream. The Canadian dream is to own a house and own a cottage and spend your summers at the cottage. That's like a thing in Canada here. So I've been experiencing that for the last week and really kind of refining what I want out of my retirement. And I think part of that is it's just beautiful being on the water. Just being with my 3 kids, my wife and my dog, and having friends and company continue to visit us. We were hosting every single night. We're at the cottage. We had someone different visiting us, and that was great. I love just spending time with family. And I was thinking, I'm like, what do I actually enjoy? And like, though I like growing and I like investing and in business and all that, I actually enjoy the relaxing piece more. I enjoy building a fire more than I enjoy building a business. And I mean, the money's important, and I know how life-changing it is to continue to grow, and I want to be able to provide that for my family. So I will continue to push at times to build for the sake of growth. I think it's good for humans to continue to grow and evolve and learn new things, and through learning new things and trying out my skills, I will continue to build wealth, right? It's just a function of basically practicing and refining those skills in an effective manner. If you're doing it well, you should be making money. So anyway, but taking my foot off the gas a little bit, and the more I take my foot off the gas, the more I realize that I stopped trying so hard in real estate, and I make way more in the stock market. It's like I think I'm going to pivot, and I continue to pivot. I realize that the less I am involved in real estate, the better I feel. I think back in my life, all the times I sold off properties, all the times that I had just gone through a de-levering, I was very low stress. So the growth phases are fun, but then you end up, if you grow and subscribe to too much, you end up with an issue of burnout, right? Where I see someone put a comment there. It says, how do you avoid burnouts? Eric said. And I'm not perfect. I go through burnout stages too, but I find it's nice to take breaks. It's nice to moderate yourself. And those days when you really don't feel like doing anything, it's okay to do one of those. But then the next day, push yourself through a little bit. Say, I'm just going to do an hour or two today, right? And sort of slowly ease into things. And then you'll have your times where you push yourself, 16 hours a day. If you're that type of person, the type A personality will push themselves. And that's typically how you get into a burnout situation. So you want to make sure that you plan forced breaks in whatever it is that you're doing. You have when this project ends, I'm going to take, a week, and I'm not going to put anything. I'm going to purposely block it off into my calendar. It's forced. I have to do it. I'm trying to do that this summer. It's one of my goals this summer. So, yeah. Next one was Mr. Michael. How are you doing? Good. I'm doing great. I've been enjoying the last few days. We're back in London today, only because the internet's better here, and I wanted to do a good show. And we had 2 deals closing, so I thought, I'll come back to London for that. But I could see us going back out to the cottage soon. So, yeah, I'm doing very well. Financially speaking, crushing goals that I never thought I would make. This past 5-6 months, I've been making. I haven't realized all this because you have to sell the stocks or sell the properties to realize the gains. But I've been making well over $100,000 a month consistently for the last 6 months, and almost a year actually, if you really think about it. And that's like not even 8-9 years ago, I was making 50 grand a year. I was grinding 50 hours a week for that salary, right? And so to go from some good stock days, I make more than I made in a whole year when I started on this journey. Even a few years ago, I now make more than that in a good day trading. So that to me is like crazy wild that we've had this sort of I've had this sort of growth, and a lot of it's been luck, but a lot of it's been also just preparedness and aligning to ride the wave. Like some might say, hey, you got a lucky wave and you rode it, you surfed, great, awesome. But you have to do years of preparation to know where to be and how to position yourself to catch that properly, right? And I levered up to the tits and I worked my ass off to get where I am. So, it was worth it in the end, for sure. Next one, Juice is out of AMC now. I don't know, I haven't really been following AMC a ton. I did do I did sell a bear call spread on it. So as long as the AMC stays below 145, I think I make $6,000 on that contract that I wrote. So I kind of believed that there would be a down day where I could cash that out and it'd be mostly realized. So all I need is one good down day on AMC and I'm good. Like a good 10% down day and I'll cash that out, probably 70% realized, and make most of the money on that contract. It doesn't even have to be below 145 at expiration because I'll have sold it long before it reaches the end of the contract, life. And that's what I love about options is you don't even have to be right about the direction. You just have to be right once. Like you have to have one day that's in your favor, and all of a sudden the options market goes crazy. The other day it was like it was Monday or Friday. One of the days crypto was down big time. It might have been Friday. I can't remember anymore. All the days blur together. The Cottage, it was just such a great time. But there was a down day, and I remember looking at all of the crypto-related miners and producers of mining equipment and anything that's tied to Bitcoin prices. And I looking at all those companies, and the options contracts like 2 weeks from now, expiring 2 weeks out, were up like 200%. The stock was down like 10%, but the contracts are paying 200% higher premiums. That makes no sense. The next day it corrected, and it was like on the next update, it was like they were all paying negative 100%. I'm like, oh, it's just so much easy money. So much easy money on this volatility. The only way you don't make money is if the stock doesn't move at all. And the stock always moves, up or down, it moves somewhere. So that's what I love about options trading is that you set it up so that the worst case scenario is you own the shares and companies that you like, and more likely than not, you just make money for nothing. You take very, very low risk bets that are like AMC at 145. It could pop about 145, but very unlikely. And it was a big up day that I sold that, and people thought it was going to the moon, and AMC hasn't gone to the moon. I don't know where it'll go. There could be a short squeeze. It could happen. And I'm not betting on my portfolio on that, right? Like most of my stuff's on like dividend plays and super diversified. And if crypto crashes tomorrow or another sector crashes, that's okay because I'm in all the sectors. It doesn't matter. If you're in a tiny piece of everything, you win. And you just play those sectors when they're down, and you sell calls on those sectors when they're up. When they're up unproportionally, when the options premiums are unproportionately high for, the current portfolio. It's paying more than what the stock really should. It's implying a little too much bullish momentum. And I'm not a momentum trader. I want to own a portfolio. I just like to juice up the portfolio and make a little money along the way. I'm okay saying, hey, I'm okay locking in 15% gain on my shares and just selling calls to have them taken away at those prices. So let's see. GPUs are for sale. Yes, I could sell. I also could just find homes for most of the rigs that I have. The effort to explain to people, I did an Instagram post and realized that like no one understands crypto mining. And I don't want to explain to people. I don't want to set it up. Someone has to come to my house and bring me money, take my rigs away. Okay, my time is way too valuable to be negotiating with people. Not interested in that right now. My time at this point right now. So. Oh, my kids are having a little breakdown out there. It sounds like. As soon as one kid starts crying, then the second one starts crying, and the third one, chimes in and pokes the second one. And that's 3-kid fatherhood, parenthood. Serenity says, I've been looking into rolling the wheel, but what are your thoughts on utilizing the barbell trading strategy? I don't even know what the barbell trading strategy is, Serenity. Someone have to inform me. I'm not that well educated on options trading. I dabble. I've been buying stocks and writing put options for a decade, but I haven't done a lot of in-depth. Maybe I've been doing it by accident. Like I've been doing a lot of strangles and spreads sort of, just on accident, right? Basically, my ethos is I pick 50 companies that I really like. I follow those 50 companies. I buy the shares in those companies in one portfolio. In my options trading portfolio, I mirror a lot of what's going on I have 25% of my portfolio, by the way, that's like meme stocks and crypto and high risk stuff. So that's what I like to talk about because that's the fun stuff. But I also have, puts out right now on like everything from Barrick Gold to Enbridge to Pembina to bank stocks. I sell puts on all of that. Once I get assigned, I sell covered calls on all of that. I only sell covered calls on up days when the market's irrational. I try to pick a peak when things are overly rosy and bullish. I'm like, okay, the market's extremely positive right now, like almost too positive. And if we've been having a little bit of a trend of that, I'm like, okay, this is too good to be true. Everyone's happy, everyone's bullish, I'm gonna be bearish. And the same thing is true when everyone's bearish. I'm like, okay, now it's time to potentially start selling some puts. So that's worked out really well for me so far. I've been beating the TSX and the S&P. Although my goal again is to just mirror the S&P or the TSX, but provide better liquidity and better tax advantage by actively trading, and also enjoy it more than just holding, right? So that's sort of been my strategy right now. I'm not an expert by any means. I try to, sell off a leg in a spread trade when it's favorable. As an example, if I've got a put protecting my position on a spread, if it's, for instance, a bull put spread, then I might sell the put that I bought. I might sell it off a couple days before on a down day to get rid of that so it doesn't expire at nothing. And then I might just let the put that I sold, I might just let that expire. So it just depends on, whatever I'm seeing in the market, whatever I believe the value of the shares are. It's very situational on a per share basis. Again, I'm not an expert by any means. I honestly am just trying to build a portfolio and match the market in a lot of ways. That said, I currently am insuring my larger portfolio with a $900,000 short on the S&P 500 right now. I am short the SPY, almost 900 grand right now, and it hurts. Every up day, it hurts, but there will be a down day. We will have a correction. And when that happens, I'm short $900,000. It'll be great. I continue to sell puts, by the way, to cover the losses on my short on the SPY, but there's gonna be a day where that pays out really well. And when it does, I'm gonna sell puts way in the money and get rid of my short position, right? My short position will be dissolved when I get assigned those shares, but I'm gonna wait for the market to be irrational. And I haven't seen the IV be high enough on the SPY right now. We had it that one day where there was the inflation woes. I think it was like almost a week or two ago on the Wednesday, and it was very, very bearish. And that was a good time. I made a lot of money on my short stuff there. But then I doubled back down. I'm like, you know what? It's going back up, and I'm like, this isn't right. We need to have a bit more of a correction. So I'm just gonna hold. It's insurance. I could just lose money on that, but more than likely I'll make a little bit. The next dip, I'll just get out. So yeah, just playing around, just having fun. Just doing some option trading, trying out some new strategies here and there. What's the best place or city for a newbie to start flipping real estate? Well, there is no best city, I think, other than, from an affordability perspective, the lower the cost of housing, the easier it is, I think, to enter. So like a market that's tiny, less than 100,000 people, tends to have, very low price points. It's a less stable economy because typically it's reliant on very few sectors. That type of economy is not as resilient as a strong one like Toronto or Vancouver that has better overall economic fundamentals. But you can get in a lot cheaper. You can buy a house for 150 or 200 grand still. In many areas in Ontario, you go up to, even in Windsor in pockets, and Sarnia in pockets, and Chatham in pockets. You draw a map kind of 2 hours around London. There's some outlier communities like Forest, Ontario, you've probably never even heard of, where you can buy a house for 200 grand still and turn it around. So there's lots of markets like that where you can get in. And flipping really just requires you to buy smart. That's the number one ingredient. Buy smart, and then reno and add value smart. So sometimes it means getting rid of tenants. Typically, ideally, you buy it vacant and you just renovate it. And you do strategic renovations where you can spend, say, $10,000 really effectively on like paint and floors, and maybe you add a bathroom or a bedroom or change the layout very minimally, and you quickly turn it around for max dollars. The idea is to spend 10 or 20 and unlock 70 or 80,000 in value or something like that, and get a nice juicy return on that deal. So that's the idea of flipping, is being able to renovate cheaply and affordably, and focus on those renovation items that add a lot of value for the buyer. So paint has a really good ROI. Kitchens and baths have great ROIs. Flooring has a great ROI. Simple things like that tend to make you great returns when you're flipping. So I love flipping. I still am actively flipping, though I'm getting rid of my buy and hold stuff. Flipping can generate a triple-digit return if you do it fairly well. So I like that. I like that I can get 400% higher return by flipping real estate than I can by holding it. So why would I trap my capital holding it and leaving it to die on deals that don't produce? That said, there are some ways in multifamily where you can buy and hold and make great appreciation strides. And as you turn the tenants over, get some great lifts on the portfolio. I just don't want to be in that game right now. I'm just not interested. And I've been that guy. Go check out Mike Rosehart at CBC. They ran a hit piece on me. And I had a tenant that, basically blasted every media outlet and blamed me for a tenant I inherited. Again, it all comes back to me. I'm a social media guy. I'm on social media. People can find me. I don't want tenants to contact me. I don't want to be involved. They go around the property manager, and it's annoying. I don't want that in my life. For $10,000 an hour, I don't want that in my life. I don't want to go to the landlord-tenant board. I don't want to be subpoenaed to have to go and deal with the building's problems that I just inherited. Because when you buy these properties that are a great value, they come with bad tenants. They come with problems in the building that the old landlord hasn't addressed, and they become your problems. And you inherit them, and you have to solve them, right? And solving problems makes you a lot of money. Money isn't that important to me anymore. It was really, really important at a time, and for a lot of people, it might be the biggest thing. I can get a 20, 30% annual return on most of my capital without having to do much work at all. And so I would want to do work to make 50, let's say. I'm happy with 30% annualized. You know what I mean? Like the kinds of returns I'm getting using leverage with other investment vehicles like options trading, like some of the creative stuff you can get into in private lending, like in some of the things you can do buying businesses, especially in investing in off-market opportunities with businesses. I love all that stuff. That's awesome. Like the stock trading is my favorite. It's the least amount of work. Real estate, again, if I have a good active partner that's flipping with me, which I do have, I've got someone in Sarnia right now that we're doing 3 flips, and we'll continue to do more, probably do 6 a year, 6 or 8 flips a year. I could see us easily doing. He's an active partner. He's running things. I'm the money partner. I'm the deal partner. Those are the things I bring to the table. It works out really well. That's a good symbiotic relationship that I like. I'm okay with that. If I have a running mate that wants to do a lot of the work that's still in the growth phase, I'm happy to be part of that, to mentor and provide guidance. But I don't want to put in a lot of time. I want to put in my capital, and I want to put in, I'm good at finding deals too. So those would be the 2 areas that I really want to lean in, right? Real estate comes with a lot of risk too, a ton of risk. The City of London and the rental licensing program is a ton of risk for landlords. I've seen fines of 5 or 10,000. I've seen basement units be shut down. You cannot rent it out. Barred. It's not 6'5" down here. Doesn't have proper egress. You're not allowed to rent it. Boom, your cash flow's done. You invested in a property that was supposed to be a low risk. It's real estate, no risk, and tons of risk. Right now you have negative cash flow. Or you buy a property and you find out there's a major foundation issue. And you end up, and I had this, by the way, we had a foundation wall actually collapse because a bad contractor tried to underpin and do a French drain along the whole thing, and the foundation actually collapsed. We had to rebuild the house. So that was like, and the contractor didn't have proper insurance, of course, they disappeared. and the general contractor who was managing it was like threatening, you know, you can't sue me or else like I'll come find you and throw you in a box in the bottom of the river kind of thing. I'm being a little facetious, but like that's what it's like. And we ended up, basically the result was we ended up pulling the bag. And that happens, you know, that's the bullshit you deal with. Like I've been through it all now. I've had a fire, I've had a flood, I've had a foundation collapse on my property, like daylight through the basement, foundation collapsed, hydro had to be disconnected, water, everything redone. Like I've had all those things happen. And from doing, you know, near 100 deals now, I can tell you, it will happen to you. Not very often, but when that happens, and if you're unlucky and that happens to you, real estate carries with it risk. Insurance didn't pay. Insurance didn't come good for it. Guess what? Out of our own pocket, 150 grand. Luckily, appreciation has saved that property, and we were strategic about how we've re-renovated it with a new foundation. I think we'll end up selling it for a small profit. But man, I've been through so many horror stories I can tell you about, and it's brutal. It's brutal going through this. You know, I feel like as a real estate investor, when I hear other real estate investors say real estate carries with it the lowest amount of risk, no, not true. The highest amount of stress and a fair amount of risk. Like I think, you know, if you're lending against real estate, a 75% loan to value or 80% loan to value maximum. Okay, agree, very low risk. To lose 20%, very statistically unlikely. Those events I told you about, like the foundation collapse, usually insurance would come good on that. Typically, in most cases, you'd end up in a situation where where it would all work out in the end, and you typically not lose your money. Even the land, to be honest, when the foundation collapsed, the right move was just to sell the land. We should have just walked away and said, hey, we bought this thing for below replacement cost. So I actually, when the foundation collapsed, we were still at a profit. And we thought we could repair the foundation for less than it ended up costing us in the end. But the right move actually at the time was to walk away from the property and sell it for land value, and we would have made a profit and not had to dump a dime into it because we bought smart. And if you continue to buy smart, then real estate has a low risk. If you manage your risk, you don't have to worry. So that's a key piece. Hey Aiden, how you doing? I hope the Navy's doing well for you, and someday I hope to visit you in Australia. I'm glad you super chatted. Good to see you on the stream. It's been a good while since we connected. Okay, next question was, I've been looking into rolling the wheel, but what are your thoughts on utilizing the barbell trading strategy? Oh, I think I did this question already. So I like rolling the wheel too. The idea with running the wheel and rolling the wheel is basically you just pick companies you like. Obviously try to pick a lot of different companies that you like. Don't pick like 3, because then you're taking a huge amount of risk. You could lose everything. And then I like to sell puts way far out of the money. So not close to the current stock price, but way below. I choose a strike price way below. And I might go 2 months out, something like that. Depends on the stock, and you gotta look at when dividend dates are and what kind of news is happening. But I'll pick a date roughly 2 months out, and then you get some decay over time where you make money for nothing. And ideally you close that contract out. If you have a really good day where you've got almost all the contract value realized, you could roll that. And basically it's like selling it and then buying something new, but it's called a roll, where you could roll that put. On an up day, you could again decide just to strangle the stock if you've sold a put on it now and you're making a lot of profit or something, and it's a big up day, you could sell a call on it now. So now you've sold a put and a call. But the idea and that would create a sort of a strangle. I'm getting into complexer strategies here, but basically running the wheel is the idea that you sell puts on companies that you like until eventually you get assigned that company. Once you get assigned those shares, you own those shares at a discount because you sold puts on them. Awesome, money for nothing. Got the shares for less than you would have had to do if you just bought them on the open market. So selling puts are an easy way to do it. Next, once you own the shares, you start selling covered calls on them a couple months out, a month out or so, and you sell them before they expire ideally. 15% out of the money or so. That guarantees you a 15% profit on the shares you currently own. So you roll those shares. Eventually they get called away. If they don't, you make 1% or 2% a month selling covered calls, trying to get rid of those shares that you just got assigned. And you repeat the process. That's running the wheel effectively. Okay, next question. How many sources of income did you have by age 18? When I was 18, I had 1 source of income. No, 2 sources of income. When I was 18 years old, I was in my 2nd year at Western University. I was 17 when I went for my 1st year. I had like 4 sources of income. I had a scholarship, I had another scholarship, I had a bursary, and I worked 30 hours a week at Canada Border Services Agency. paid like 16 bucks an hour at the time. I worked in the duty office where I would assess goods, working with the officers behind customs. It was a great summer job. They offered me a position to keep working while I was in school. I drove for the southern border. It was an hour each way. I loaded up my entire class schedule from Monday to Wednesday, and then I worked Thursday, Friday, Saturday, Sunday at 8 or 10 hour shifts at that location. So that was what I did. When I was 18 years old, I almost worked a full-time job and went to school full-time and maintained an 85 average at Western, got into Ivy, and then had some scholarships and things. So those were my sources of income. Because I didn't have a lot of assets at the time, I think I had maybe at the highest point like 15 grand or something in an account that I was, actively I wasn't options trading, I was stock trading on. I didn't really know what I was doing with options trading when I was 18. But I was 18, I had a stock account, and I remember buying, my experience leverage by accident. I put an extra zero on a share trade just by fluke. I bought too much and I realized what margin was. I was like, oh no, I bought this on credit. Like I only have 15,000 in my account, but I bought $30,000 in shares. And then I remember the shares dipped like 5%, and I was like, losing my pants. And I was like an 18-year-old kid, like afraid I just lost like 3 months salary, working full time. I have to work now to make this money back. But then I got lucky, the next day it popped off and I made like 10% up. I was like, okay, I'm getting out. I sold the shares. And that was my experience with leverage at 18, with just stock trading, just basic. I bought a collection of like 10 companies. I didn't really understand diversity. I didn't understand that I was supposed to build a collection of different sectors and companies in many different sectors. I was like, I'm going all in on at the time I was like gold, silver. I like gold miners and silver miners, and I picked a bunch of other companies I was obsessed with, like 5 companies I was obsessed with. There was some tech stock. I think it was RIM, Research in Motion. RIM became Blackberry, which then became meme stock, which is a joke now. But at the time, a Blackberry was an amazing thing. This is 2010. End of 2010. I remember I was investing in stocks there in 2011. And at the time, RIM was still a solid company. They hadn't gone the way of the dinosaur yet. So it was fun, just buying shares in companies. I didn't know what I was doing. I didn't know how to value a company. I didn't know how to properly read a balance sheet or an income statement or understand an analyst report. I was buying a momentum, basically. I was just, I'd read some reports. I liked the company. I liked what they were doing. I was like, I want to invest in this. Unlike how I invest today. But anyway, I didn't have any passive income back then. I had only active income because I didn't have any real assets yet. So it didn't really matter what I invested in, because at that point in time, it was all about what I could make and what I could save. When you're young, you're starting out, it's even 50% return on 10 grand is 5 grand. Who cares? It's not going to move the needle for you. What really matters when you don't have a lot of net worth, a lot of wealth, is you need to start working and making income. You need to find ways to pick up side hustles, side entrepreneurial hustles to make money, or find ways to get a full-time job to make more money. It's all about what you can make and then what you can save of that. Because every dollar you save when you're young is $68 when you're retired. So if you save 10 grand now, that's 680 grand when you reach retirement. You save 100 grand when you're 20 years old, and that's 6.8 million in retirement. You gotta remember the power of saving now. Saving is so important. Once you get to my net worth level and you've got some achievements and you've unlocked a good amount of net worth, what you spend doesn't matter as much. If I spend 50 grand a year, 20 grand a year, 100 grand a year, it doesn't really matter. It's such a small percentage of my earnings now, my passive income snowball, that it's just not impactful like it was. A 1% change in my portfolio return has a huge impact now, whereas before, 1% difference in portfolio return didn't matter when I didn't have any assets. I had like 10 grand to invest. It didn't really matter. So I think it's better to focus on. Of course, it's important to invest in something. Have your money working for you. If I had 10 grand, to be honest, and I was 18 years old, I would just spend all 10 grand in crypto. To be honest, if I could do it again, when I was 18 years old, I'd put the 10 grand in crypto, and I'd pick ETH, Bitcoin, Ultra, Kudos. I'd pick maybe some Litecoin. I'd just spread it around and buy some crypto, and then everything else I saved, I'd buy my first house hack, and maybe I'd cash in that crypto to get the first house. Once you've got that property, that home base that you can live in for free, get your living costs down to zero, then all your paychecks can go right into investing in the stock market. You can practice the options trading. You can learn. It's not as important what you're making, but it's important that you're learning, because that knowledge base is going to be huge later on, right? You can take that knowledge that I had at 18, 19, 20 when I was just learning and making mistakes. It's better to make mistakes with $10,000 in my account than making mistakes with, say, $100 million in your account, right? So you want to make sure that you're making those mistakes early and learning from them. At the time, $10,000 was a lot of money to me. And now it's a rounding error almost, right, in my portfolio. Up or down, if I have that kind of volatility in it, within 10 minutes in my portfolio, often I'll see that kind of movement. It's crazy how, you evolve as an investor and you evolve as you grow along the business and personal development curves. Okay, next question. Appreciate your live, Mike. Chris says, please give us some tips on hiring subcontractors for reasonable rates. Chris, I'm out of the game, to be honest. I'm out of touch. There was a time where I could squeeze and grind subcontractors, and I was so good at it. I was getting guys laying floor for 70 cents a square foot, vinyl click plank and laminate. I'd have, but they didn't. There's three things you got to remember. First off is that you can never have all three of these: reliability, affordability, and quality. So if you're getting a cheap guy who's really affordable, I guarantee you if he's doing good work too, he's not going to be reliable. You're going to pay him, he's not going to show up for 4 days until you spend all his money on a bender, right? Like, or on a bender or whatever. Like that's the reality in the subcontractor world. If you're getting a good quality contractor who's doing good work and they show up every day when they say they're going to show up, that's going to cost you money. That said, though, you can build a rapport with the subcontractor, feed them all out of jobs, maybe go out for a drink with them, build some rapport, and they might hook you up. They might like to be around you if you work with the subcontractor and you're there, while they're hustling, you put some music on, you bring some beers and pizza, they might hook you up and they might give you a deal, right? Because they're just enjoying their time. Whereas if they hate the job and they're doing the hardest, worst installation in like a basement, it's like smelly and stinky because there was dogs there from the tents before, and you don't show up, you just tell them there's a key and they let themselves in, they're not going to give you as good of a price because that's not enjoyable work. So part of it is the atmosphere that you can create for those subcontractors. Another thing is just you got to rotate through them. A lot of people get stuck with one subcontractor, and I find that you got to have a couple and bring them in and make sure that they're pricing each other fairly, making sure that the quote is keeping the other guy sort of fair. And I want to say what's the word I'm looking for? Like when you keep someone, when two people keep each other in check, kind of thing. I don't know. That's not the word I want to use, but basically they're keeping each other in check. When you bring the other person's quote to them, you say, hey, this is what's happening. This is the price. Will you match it? Okay, yeah, you've been giving me business for so long. Yes, I'll match it, whatever. And then boom, now you got a great price. So that's, keeping them honest. That was the word I was trying to use, keeping your contractors honest. And it's key to have other contractors come in behind the next subcontractor and look after them. So for instance, when your framer's finished, your electrician's finished, your board guy is going to come in who lays the drywall. He's going to tell you if your framer's, out of whack. Like, hey man, he didn't do any back framing here for me. He didn't frame this wall straight. He wasn't thinking about the next trade coming after him. And trades always complain about the next trade after them. It's a very common theme. But if there's a lot of issues, that's when you'll notice that, that's when you might notice, hey, okay, there's something wrong with this subcontractor. Or maybe that subcontractor is so cheap that you're like, you know what, for this rental property, I know there's 50 seams in the floor that aren't perfect, but who cares? It's okay. It's just a rental. They're going to destroy the floors in 5 years anyway because it's a student rental. I have to replace them, whatever. Like no vinyl click lasts more than 5 years with a student rental. That's just how long they last. Any rough tenants will destroy a property real quick. So if you're doing that kind of reno, then it doesn't really matter, right? In that case, it's like, okay, just get the cheapest guy in there and to do it. So one way is just go on Facebook, go on Kijiji, keep ads running, looking for people, go on Kijiji and look for people who are posting, message them, continue to bring new people and fresh eyeballs onto sites, build that Rolodex. At one point I had 10 of every trade. So I had 10 plumbers, 10 electricians, 10 boarders, 10 tapers. My list is probably dated. Half of them probably moved out west, or with the trades, it's very transitory. People are in and out of the trades. They get a job in IT, they're done, their knees are shot, they move out west, they had a drinking problem, they go to jail. There's a lot of that stuff in the trades, especially in the lower price point area where you got scab trade guys who are just working for themselves. You get a lot of that. So I'm tired of that business, to be honest. Like, you couldn't pay me $1 million a year to run a contracting business. I have no interest in being involved in that whole drama, the drinking and the drugs and the payday every Friday, and they're on you all the time, and you got to ride them because they're always making mistakes. And that's the job of the GC, right? It's the job to follow behind and correct guys' mistakes and keep them working. It's a lot, it's the worst part of real estate, in my opinion. There was a time where I'd get off work at 5 o'clock and I'd go till 2 a.m. every single night. On Saturdays, I would get up at 9 and I'd go there till 9 p.m. and then I'd relax and watch a movie on Saturday night. And when I had the 3 rental projects going at once, my first 3 big renos, my duplex conversion. I remember I was going there just doing that every day after work, and I'd be working, picking up a brush, and because I was there working, the morale was good on site. And when I stopped doing that, I stopped grinding with them, I realized that the productivity really dropped of the sub trades. So that's been my experience with it, and I'm just tired of it. There was a time where I really enjoyed it. I don't enjoy it anymore. I get PTSD when I walk into a Home Depot or a Rona or a Lowe's. I try to do online ordering. I try to get other people to order for me now. I'm just done with it. Just don't want to do it anymore. That's where I'm at. But if you're still, starting your journey, there's a funness to it in the beginning, a learning process. When you're learning the trades, you're there painting, and the guy might show you, hey, this is how you hold the brush to cut in better. This is how you lay some trim. Oh, here, can you give me a hand? I just got to install this cabinet. And you hold the cabinet for the guy because he's got to, he puts the strapping up and he puts the cabinets up and he shows you while you're doing it. You're holding the cabinet, you're watching how he installs cabinets. And then the next cabinet guy doesn't show up. It's all like, oh, hell, me and the painter will put these cabinets up, and I learned how to put up cabinets. I'm like, oh, here's how you put a sink in. Oh, okay, I learned how to plumb. And I learned how to do that because I was on site working with the trades that I'd hired. That's why I learned the trades, was being there, being their boss, and not knowing what I was doing, learning from the people I was managing. And so that's been my experience with construction, and it's a terrible industry. I hate the trades. There's so many chemicals, and people are just, there's some funness to it. There's a lot of crudeness to it too, and there's a lot of stress as well in the trades and a lot of injury and stuff like that. So, overall, I'm glad to be out of it. Next question. By the way, if you're in the trades, I'm not trying to dump. I'm just sharing my experience for those people who just want to hear it. Yeah. PewDiePie says, not the real one, says Tesla is doing pretty well. Just smash the like button. Oh, thanks. I'll take your cards. MSRP, I'll roll today. Yeah, no thanks. I bought them off scalpers, so I would definitely not sell them at MSRP. But I would sell them at market value on Facebook and Kijiji. Track your readiness and recovery with an Oura Ring, official health tracker of the NBA and UFC. I've been looking at getting an Oura Ring. I have some friends who got one, and I thought about getting one and then just forgot. It's a good idea. I should get an Oura Ring. That's a great tip. What do you think about someone being 100% invested in Tesla with 25,000 Canadian? I mean, it depends how important is that $25,000 Canadian? Do you need that to eat? Is that all you have? If the $25,000 is all you have, I think you should you should sell out and not be in Tesla $25,000. I think you should put $2,000 in Tesla and $2,000 in, some crypto plays, and $2,000 in, some bank stocks, and $2,000, pick a bunch of different sectors, right? And spread it around a little bit. You'll be better for it in the long run than putting it all in one company, because who knows what happens if a rival of Tesla builds something better. A better car, right, or whatever. And by 2035, Canada is going to be all electric cars. So there will be many different car manufacturers beyond Tesla, and eventually they will all be comparable cars. You're going to be innovative and ahead of the curve so long. Tesla is ahead right now. Definitely, no doubt about it. They have the best electric car on the market, in my opinion, right now. But some of their competitors are getting closer. And at some point, there might not be a competitive edge anymore. Who knows? Or the competitive edge might not be monetarily significant, meaning it might not justify the current valuation on the company, right? Who knows? There was a time where many companies were king of the hill, and now they're, mid-cap stocks, right? It happens all the time, like Yellow Pages, or whatever. Pick any other company. Lots of tech companies too that we don't use anymore, like Yahoo or Ask Jeeves, right? But or look at Blackberry, perfect example. Was Research in Motion. They were huge. They were the cybersecurity expert, the phone expert. Like the president used Blackberry phones. Like that was the thing, right? Everyone's like, they're the company. But who knows? Like Apple might be garbage next. We might be using some new phone 10 years from now, right? Who knows? Who knows? We don't know. So that's why we don't put all our eggs in one basket. We spread our eggs all around in many different baskets. There are lots and you can argue with me, hey, I don't care what happens to this money. I don't need it to eat. Cool. If you don't care about what's happening to it, put a little bit in NFTs, pick some crypto, buy some Tesla, buy some GameStop, whatever, play some meme stocks, have some fun with it. Don't bet the farm. Don't bet something that's actually going to kill it, make you not be able to sleep at night if it drops to zero. Prepare yourself. If Tesla drops to $100 a share, are you okay with that? And if you're cool with that, okay, fine. I still think diversity wins in the long term. Pick 10 growth stocks that you like in a couple different sectors. That's still better than putting it all in one. Don't put it all in GameStop or all in Tesla. Spread it out. Pick like 15 stocks. They're all super high risk if you want, but at least you're diversified among the high risk plays. If that fits your investor profile statement, your IPS that you've made for yourself, and you're like, hey, this is the risk profile I'm comfortable with, and you decide on that, at least diversify within that risk profile. At least buy some crypto too, and then spread it around. Not just put it all your eggs in one basket. Don't go all in crypto or all in Tesla or all in the meme stocks. You know what I mean? Like, spread it around a little bit. Just basic financial advice that will definitely pay off for you in the long term. Want to go to zero, want to go to the moon, and 3 will just, be flat. That's what will happen when you pick 5 versus 1, right? Better than being unlucky and having that one that sinks in those likely scenarios when that happens. Are you still running 3 times leverage in your portfolio? Jordan, no, I'm not right now. I'm running 3 times leverage. I'm probably closer to 35% leverage right now. I should get better on that. I am still more levered than I should be. What's your take on public home builders? I don't even know what public home builders is. That someone has to give me some enlightenment on that company. I will reserve my opinion because I don't know enough to give an informed opinion on it. For your dividend strategy, what do you think about using a covered call strategy, selling deep in the money calls focused only on receiving dividends? Yeah, you could use calls where you sold the call just after the dividend ex-dividend date, or the date you're going to be able to be paid basically those dividends. Just after that, you could sell calls pretty close to your break even if you wanted to, that paid extremely well on the right day, depending on what day you write them. You could potentially write them and they could pay you very, very well. If, for instance, you had a big up day on the stock, you could sell covered calls that day at below the current price, closer to your break even, and you would get a huge premium for that. And in some cases, that can be 2, 3, 4% a month annualized selling covered calls in your portfolio, plus the dividends. So yeah, selling covered calls can be great. The awesome part about selling covered calls is that all you lose is the shares you already own. They're covered. You're not, if the stock pops off to the moon, that's okay. You were only in it for the dividend and the covered call premium. You said, I'm okay making 3% a month. The stock moons, whatever, my portfolio is designed to make this return. You cap your upside, but you define a good amount of profit, and you basically limit your downside a fair bit, in my opinion. And worst case, you just keep selling those covered call premiums on those high up days, and you can really juice your portfolio up. I think it's achievable, without a lot of risk, to really make 1% a month selling covered calls on a dividend portfolio. And then with leverage, you can make 10% just on or 1% a month just on your dividend portfolio as well. So there's 2% a month right there. It's 24% annualized. That's fantastic right there. About taking very little risk, you could achieve that in a portfolio. There is some inherent risk, and I think you should save most of your leverage, ideally, for, let's say, go for 6% dividend return with using no leverage, and keep all your leverage for the dips. And when the market dips, that's when you sell puts. You go hard on all those positions. When you see bank stocks like they were during COVID, you see all the prices of everything way down, that's when you use your leverage. You can go 3.34 to 1, right? When the market's at a bottom, you see a 30 or 40% dip, that's when you go hard. Historically speaking, you will make bags and gobs of money if you go hard when the market's bearish. When everything's crashing, as soon as you see a 10 or 20% crash, that's the time to get in. That's the time to use your leverage. And you will make mountains of money. So I believe in saving leverage for dips. It's just how you identify when we're at enough of a dip. There are some basic metrics you can look at, but I think a 20 or 30% overall average market pullback is clearly a recession. You could look for, you'll see it in the news. You'll know when it's a recession. It'll be all blood in the market. It's easy to smell it. Just picking the bottom, who knows? You dollar cost average all the way down. You're at 20% down, maybe it falls to 40% down, but you're buying the whole way down. You don't know where the bottom is, but if it bounces back tomorrow, it's okay. You got shares at a 20% discount. Because remember, 5 years from now, the shares are always going to be, on average across the whole market, higher than they are now. That's just a fact. Next question was, just smash the like button. Thank you for that. So someone says the barbell strategy is 80 to 90% super safe investments, 10% super high risk investments, far out of the money options with a convex payout structure. So when a huge event happens, you are in a good position. There you go. So I did not know that. I think that probably I'm not quite practicing a barbell strategy, but something similar to that, in that, like, a good percentage of my portfolio is in relatively stable stuff. I stay away from bonds. I hate bonds. You'll notice I have 0 bonds in my portfolio. I would prefer to have, recession type plays in my portfolio that will do really well in recessions, and they're like my insurance in a recession. I'd rather that much more than having bonds. Bonds, I don't like the idea of paying someone back, a face value when I believe the currency is devaluing over time. So bonds are a terrible idea when you believe the real inflation is, like I do, double or triple the current CPI, and current CPI is like 6%. So I think it's really like 12% at least right now. So I think borrowing, a bond, a treasury, bond paying like 1 or 2% right now, almost nothing, you're actually going to lose money, in that type of environment. So that's just my belief when it comes to bonds. They don't perform well enough for the risk profile. I would rather lend against real estate and build my own bond portfolio using, private debt and make 12 or 14% for the same risk profile as lending to the government. In my opinion, I think lending against real estate, 75% loan to value, is the same as lending to the government. The government will step in and protect real estate before there's more than a 25% correction in the prices of real estate. That's just a fact. So I much prefer to get 400% higher returns doing private lending than I do in the bond market. So I have 0 bonds in my portfolio. I plug in real estate and private lending for the bond substitution in my portfolio. And that's just my personal preference. I'm 100% equities, and I balance that out with real estate and lending bonds, the private lending security against real estate. That's my bond in my portfolio. And in times of, recession, I keep leverage aside. I could also pull those, loans. Typically, stock market recession isn't always tied to a real estate recession, so you can typically get some liquidity from those. You could always sell your private mortgage contracts to people. They would love to buy them, especially if you have, a great first mortgage at 10%. There's always someone out there who would buy it for 8%. And so you can sell it and make a profit and get your cash out and your liquidity out. That's a nice piece as well. So yeah, I'm not perfect. There are probably way better investors than me. This is just what I'm doing. It's what works for me. I'm more sophisticated than some other investors, but there are, I'm sure, many investors more sophisticated than myself with better strategies than myself. Hey guys, I'm Canadian. Nice. Best investment for under 5,000 in your opinion? I don't know. I like cryptocurrencies, to be honest, right now. I think for people just getting started, it's a great way to kind of get involved, and really you could really do a 3 or 4 bagger type return investing in like Ethereum right now. I think Ethereum will be 10,000 a coin in the next 5 years. So that's something that I wouldn't put it all on Ethereum because I don't believe in putting it all in one thing. Spread it out. But I think if you got a little bit of money, it's a nice thing to get started in. If you built a little bit bigger portfolio, then I would get into options trading with like 50 or 100 grand. I think it would make sense to start moving into experimenting with options because you can use leverage at Interactive Brokers and borrow at 1% interest rate, 3-to-1 if you wanted to, and build a pretty cool portfolio that's got a lot of protection in it. So you've got that spread, so you're not taking a lot of risk on that leverage. You got to make sure you protect your downsides. Where's the best place to camp with no bugs? I have no idea, to be honest, about camping with no bugs. First, there's bugs. Like wherever there's nature, there's gonna be bugs. So maybe camping in a parking lot. You wouldn't have a lot of bugs in a parking lot in a city, in a Walmart. I don't know how good of a camping experience that would be. What was the best way you found great subcontractors or to keep them happy? I covered this already, I think. And the best way to find off-market deals, connect with people. Connect with realtors who are likely connected with multifamily. So find realtors who specialize in multifamily listings, talk to them, see what they've got off market. If they have a friend who's got something, talk to those people, take them for coffee, build a rapport. Talk to wholesalers that are in that space. Less and less wholesalers. They're building really robust lists here, and often you're overpaying on the off market. So you can get better deals sometimes through realtors who don't have good networks. Next, I would say is go to Facebook. Go to Kijiji is a great place. People throw buildings up for a quick minute, and you can find stuff there. Flyers, door knocking, go through the rental licensing programs, talk to the city. Property managers are a fantastic way. Find the large property managers. Say, hey, do you have any landlords who are just pissed off, have a big problem in their building, bed bugs in their building, a big water leak, a roof issue? Can you connect me with that person? Like, I want to give them a cash offer. I'll keep using you as the property manager. Property manager's like, cool. And it's, hey, I'll give you $5,000 if you can connect us and the deal comes through. Boom, property manager gives you their number. You can talk to some multifamily owners. That's a great way to get connected is through property management. Yeah. Is it worth spending $5,000 to fix cracks in a sidewalk? No. you will never get that back. No one cares about the sidewalk. You could probably just refinish it over top for a lot cheaper, or spend $850 to raise the concrete and refill the cracks every few years. I don't know. I honestly don't think it matters that much. Like, cracks in the sidewalk don't affect resale value that much. You could resurface it maybe if you're doing a flip. You could put some epoxy on it or something so you don't see any of the cracks. But people don't care that much. It's non-structural. Sidewalks don't matter. They're just cosmetic. Should you invest in Dogecoin? No. Put like $100 in Dogecoin, have a little fun, but like, no. Don't invest heavily in Dogecoin. It's a shit coin. The people's coin. Michael says, what is the minimum cap rate that you must get to make an investment? Do you think your return as a cap rate minus cost plus appreciation all multiplied by amount of leverage? So William, it depends on where you're at in your journey. I think that if you can get over an 8 cap, it can start making sense. For me personally, it would need to be a really juicy deal. Almost always it matters more about the partner that I have on the deal and who I have actively managing it. That matters more to me than anything else. I don't want to do the work for any cap rate. I mean, I'm sure there's some cap rate that I would buy at, like a 20 or 30 cap rate. I'd probably buy the building at 3 to 4 times leverage. Ideally, the more levered, the better. So 25% down being like a maximum in an ideal world on commercial. Alan says, Blackberry and RIM was the go-to for most companies back then due to their proprietary encryption technology. It's true. If you had a company phone, it was a Blackberry. It's very true. What advice do you have for a 13-year-old? So Mark, it really depends on the type of 13-year-old, but probably just start broadening your horizons, start learning. It's about building knowledge now, this stage in the game. You can't quite invest yet, though I think technically you could probably buy cryptocurrency, but you can't own real estate until you're 18. Someone can own it for you in trust, but you can't own real estate until you're 18. You also can't own stocks until you're 18. Someone has to own them in trust for you, so far as I know, unless they change that law. But just learning right now when you're young and building up like side hustles and income and skills is the most important thing, but income is good too, and saving that. Build good saving habits now and start investing. Even if it's small amounts of money, $50 here or there, $100 from grandma, cut some lawns, make a couple $100, save and invest that. You're 13, so like you have so much time to learn and practice. This is the runway before you start flying, and you fly when you're an adult. So use this time now to learn, build skills, start working, and start saving. Every dollar you save now is exponentially more money later on in life. If you look at the average S&P 500 returns of even 7 or 8% annualized for the last 100 years, the next 70 or 80 years from now, you can invest even $10 and it becomes hundreds of dollars by retirement. So every bit you can save now is hugely impactful. Would you be as successful if the properties you bought didn't appreciate so much? Clearly not, right? Like probably 40% of my net worth right now is attributable to the market appreciation we've had, maybe more. Would I still have millions today? Yeah, for sure I would. Before the market ever appreciated in 2016 in London, we had, like the market looked like this in London, Ontario. We barely outpaced inflation. I bought a property in 2012 and I sold it for 2015 at the same price. And I renovated it and I barely made my renovation money back. That was how London market was. I got smarter and got better at renovating. I got better at buying and smarter at buying. So I did start making money on my next deals in 2014, 2015, 2016. By the end of 2016, I'd amassed, and even in early 2017, I'd amassed almost 17 properties. And I was already a millionaire before we had any appreciation. So just time value of money, it would have been impossible. With zero appreciation, I would have been multi-millionaire today. Appreciation made it better, for sure. It fixed a lot of mistakes I made along the way too. But most of my early investing journey, like before my grind to financial independence, till I was 24, I had almost no appreciation. So I got to retirement with no appreciation in a flat market. So it's doable. Anyone can do it. You don't need an appreciating market. Appreciating market makes it better, makes it easier. Back in the day, we would spend weeks negotiating on the same property. There were no buyers. Like the realtor would just call you back a week later and be like, hey, we'll come down a little bit, put another offer in. Let's just try and do something here. We'd counter each other back and forth for days. No one else would come in. That was the market. That was how it was. Now it's like, it's just craziness. Irrevocable, as tight as you can get it, and multiple offers, and just a different climate now. In some ways it's better. In some ways it's worse. Depends on the angle that you look at it from. But yeah, for sure. I've been very lucky in the last specifically like 2018, 2019, and 2020, and even to now have been amazing appreciation years. I wished I'd been better exposed to take more advantage. I closed off a lot of partnerships that I could have kept open. I could have made a lot more money had I been more bullish on the real estate market. I always take the, protect what I have. I'm all about like, I'm not risking it. If I've made $100 in poker, I'm like, okay, I'm good. I'm gonna check out. Other people, like the people that went all in, they did very well through appreciation. But I've always banked on the fact that it may not come tomorrow, and I'm prepared for that scenario. That's my investing strategy, is like, how do I not lose money? And so because that mindset I have, I didn't benefit enough from the appreciation. I was like, how do I not lose money? Instead of focusing on like, how can I make the most money? I was buying stuff that's like super cheap rentals that didn't appreciate as much, but provided really great cash flow. And I knew I bought at below replacement cost what the land was worth. So I couldn't lose any money. It was hard for it to go any lower, but they didn't tend to appreciate as well as like the excellent properties, the single family, really nice properties. They doubled in value, whereas mine went up like 40% in appreciation because certain sectors don't do as well from an appreciation perspective. So I've never been an appreciation investor. I would be richer today, I'm sure. I have a few more millions if I had focused on that strategy. But again, I don't have a crystal ball, and I would rather take the safe road than the risky road. Now I gamble a little bit. I have a little fun with some of the risky investments with a very small percentage of my portfolio. You'll see me messing around with crypto and meme stocks or whatever, playing around with that kind of stuff, with the higher risk stuff. That even the appreciation real estate plays, I might get involved in those because again, I don't need the cash flow to live. It's just play money. I might as well take a little risk with it. If it moons, cool. Como says, since you like precious metals back then, what is your take on them now? I like precious metals a lot less now. I've always been very bearish on long-term fiat. I've always believed that inflation was a terrible thing, and that I've subscribed to shadow economics, websites like Shadow Economics since 2010. And back then, I believed that the currency was being printed, and there's too much debt, printed faster than the economy was growing. And so I've been bearish on fiat for a long time. That's why I like gold and silver. And I like producers of gold and silver. Now I just like crypto in that space. I still have some Barrett gold and whatever, but I do like crypto a lot better. It's a digital version of the same thing. It's like gold, but I can lend the gold out at 12%, a month. It's a cash flowing digital gold that I can store in a very small amount of space, whereas gold, you need a lot of space to store all that, right? So I like crypto. It's a better version of gold, I think. And you followed me 3 years ago. I hated crypto. So I finally got on the bandwagon, and it took a long time for me to come around to the idea, but I'm there. Just took a possession of your first rental property. Awesome, Mark, congrats. Flat Pat says, you need to start proving that you have all the wealth you claim to have. No, I don't care. If you want to follow me on Instagram, you can see I literally post all of my profit screenshots every day at Mike Rosehart on Instagram. You can go check it out. I have a bunch of save stories there. You can click through it. You can see every day I post my daily trading profits. I share where some of my accounts are going. You can check it out for yourself. You could do a title search on my corpse and my personal. You can see all the properties that I've owned over time, or you can see what I hold now. But I don't care. Check it for yourself. It's all good. Yishi says, hi Mike, hey, how's it going? Jordan says, what's your trading strategy for low VIX environment? Do you still sell puts? So yeah, I guess if you have lower volatility and you're in an environment where it's not as conducive, I think puts still make sense because you get a discount on the shares. Like rather than just buying the shares, you might as well just sell a put on them for like, if you can buy the shares now, why don't you just buy them in 2 weeks? What's going to change in 2 weeks on owning the shares? It's not going to pop off, right? And if you believe that, then you could do a spread trade on that, right? But yeah, I think that I like selling puts. It's a better way to own the shares. Sell puts with short expirations, like do weeklies. You can do weekly puts. You sign the shares next week. You can sell them deep into the money. So you guarantee get the shares, and you still get a discount on the current share price because there's a bit of mystery. No one knows what will happen between now and next Friday. So there's someone there who will buy that contract that you're selling, and chances are you will get the shares. So there's always someone out there who wants to make that connection. And so I like selling puts. I prefer it. It's an active trading strategy. It's more fun. It's also tax advantaged. What are your thoughts on the real estate market in Alberta? It does seem discounted when compared to BC or Ontario right now. I agree. mark. I think that Ontario is trading at a big premium. I think BC, specifically Vancouver, is too. Yeah, I gotta get wrap this up here. I put my daughter to bed in just a second here. It's been a good hour. I've really enjoyed this. I do one more for Vlad. I see Vlad on here. I've seen Vlad on here a lot of times, so I'll give Vlad his question. Mike, what would you consider any REITs after you unload some more real estate? Yes, I've actually considered REITs as opposed to, if you wanted to make a buy and hold strategy, I would use REITs over owning actual real estate. I'd flip real estate still, buy the stuff under market value. But if you're gonna hold at market, as soon as you hold the property, you're agreeing to pay at market value. Yeah, I heard you, I'm coming. So if you are holding the shares, you are agreeing to own the property at top market dollar. Because you can choose to sell it right now at top market dollar. So you're not owning it at what you bought it for, you're owning it at what you could sell it for right now. And that's a choice to own an overvalued non-cash flowing property here in Ontario. Whereas you can buy REITs where you can get a ton of cash flow and they're already levered. The REITs are already levered, at least 2 to 1. In most cases, they have mortgages that are 50% on all the properties. Plus, they take your capital and basically you could lever that up 3 to 1 as well. So that's key, right? I think that if you can buy REITs right now 3 to 1 in Interactive Brokers. So you could theoretically be 5 or 10% down on cash flowing real estate managed at scale with economies of scale, by a professional firm. And that's attractive potentially if you also had puts on that to protect against margin calls. I gotta go, guys. I can't answer any more questions. I'm sorry. My wife wants me to go. I'm tucking in my daughter, and it's important. And yes, you can definitely stake out certain cryptocurrencies depending if you want to stay in stablecoin or not. You can definitely lend it out at between 6 and 600%, depending how much risk you want to take. Some platforms, if you get out of stablecoins or even stay in stablecoins, but in some random ass platforms, you can get some crazy yields on staking. So proof of stake is the future, where you keep the coin if it appreciates, but you're providing liquidity to the exchange or lending it to someone through smart contracts. That's the future. Pay cash or finance a vehicle at 18. It depends. If you can get it cheap money, I would probably just finance it, but it could also slow down your financing trajectory and buying properties. So I think it's important to also consider the ramifications of a car payment against your qualifications for mortgages. So probably buy it in cash if you're looking to buy real estate. If you're not looking to buy real estate, then I would say lever up and get cheap debt and then invest the difference and make the difference on that money. Anyway, thank you all so much for watching. I really appreciate this hour and 2.5 minute stream. If you're watching the replay, jump in the comments and say hi. I always enjoy this, the commenting, and I like when you interact, and the algorithm likes it too. So anyway, thank you all so much for watching. No ads, as always, so I hope you appreciate that. There's no revenue at all in that respect. The secret to unlocking a wealth through you is 3 levers. Spend less, earn more, and maximize returns on the difference. That's it. That's how you build wealth. Thanks, everyone. Have a good Wednesday. See you next week.